Minutes time, 7 sharp Hong Kong. Seeing SPI futures are handicapping a looks like flat start at best. Australian dollar 74.67 in Tokyo. The big fella online in less than 2 hours time. CME Nikkei futures are handicapping a softer start. Looks like dollar yen at 113.46. Shri.
Still ahead on the program, from supply chain issues to the Evergrande overhang, there's no shortage of risks to China's outlook in the fourth quarter. Steve Cochran from Moody's Analytics tells us what they're forecasting, plus the latest on China's property tax plan, which is one of the major components of President Xi Jinping's Common Prosperity Drive. We'll bring you the details after the break. Welcome back. Intel shares knocked back 11% on Friday after reporting weaker than expected sales and a revenue miss, attributing them to the industry-wide chip shortage. And remember that the company does plan to shift its business model to become a manufacturer or foundry for other chip designers, in addition to continuing to design and manufacture its own processors. CNBC caught up with CEO Pat Gelsinger about how he expects business to pan out before the company sees the benefits of investing in the foundry.
Well, I'd say, we've laid out, the progress on our core businesses, client and data center. We've also said there are 4 growth businesses, our accelerated computing and graphics. Well, we're launching those products in Q1. You're not waiting multiple years to start seeing the proof points. You'll see those starting in Q1 of next year. We said our networking business, we're going to start giving clarity on that. And that's already a healthy, growing business, and we're uniquely positioned in 5G and Edge. Our Mobileye business is crushing it. That team is on fire at the great inflection point of the industry. The only one that will take a little bit more time to see the benefits of is the foundry business. But we've already have our first revenue with the Amazon packaging deal, our next big customers like Qualcomm and the U.S. government. We're going to be giving a lot of proof points along the way that give people confidence that, yes, this story is materializing. And the key to the foundry business is leadership process technology, which is what I already described. And we're seeing great interest in Intel 18A as just that killer leading edge product, as well as some of the existing foundry capabilities just driven by, can you build my products? Can I have capacity in the face of a global semiconductor shortage? Yeah, we're seeing the proof points. This strategy is executable and exactly what a growing market needs.
Pat, I thought it was interesting is that you talk about managing these different priorities right now. You also said that some of your customers who serve China's video gaming market are pulling back because of some of those video game restrictions. I'm curious how significant you think that impact will be, and perhaps more importantly, if you think there are other potential risks down the line that are separate from what you're working on and these supply chain challenges that we've talked so much about. What could be these other factors like that could hit in the next year?
Yeah, and the China situation we think is fairly unique and somewhat limited in time, the regulations around gaming and children online. And we expect that the Chinese cloud customers will adjust to that, maybe a quarter or two for them to finish those adjustments in their portfolio. You know, we're a bit uniquely hit by those because of our very high market share in that rapidly growing market. You know, of course, the supply challenges have been the theme for the semiconductor industry broadly. And, you know, as a result of that, everybody's limited. Our numbers would have been so much better had we been able to have full match sets coming from, you know, power supply components and network interfaces and Wi-Fi chips. And so, you know, we'd be able to ship so much more. But as it's well reported, many of those semiconductor limitations across the industry. We're doing a bit better, and we're making strong investments in our supply chain requirements. And as a result of that, we think that we'll come out of this a little bit better than others. But everybody is being challenged in this environment. But we're rapidly moving forward. Our customers want more. You know, they're begging us to, you know, deliver more capacity more rapidly. And my manufacturing team, just an exceptionally good performance because we've had so many shifts in supply and demand requirements to meet up with our customers' match set needs. So overall, you know, no businesses without risk, but we think we have a pretty good eye of how we recover. And as I've said more broadly, we expect the shortage to continue into 23, but right now is the worst. Every quarter next year will get incrementally better, and we feel well positioned in our ability to be leading our way out of this period of grave shortage for the entire world.
In other news that we're following, China will be testing a property tax scheme in some regions. According to Xinhua News, the pilot scheme will last 5 years and will be applied on both residential and non-residential properties, as well as on all landowners except those who own rural land. President Xi Jinping's Common Prosperity Drive has helped the real estate tax trials gain support recently, but they could face resistance still as China's property market is under significant pressure. Let's talk through this and the outlook for China's economy broadly with Steve Cochran, Chief APAC Economist at Moody's Analytics. He joins us on the line from here in Singapore. Steve, good morning. Let's start with the property tax in China. What is the likely impact on the fiscal position, and to what degree will it really narrow the inequality gap?
Well, I think the key thing about the property tax increase is that it creates another source of revenue for government in China. And that's going to be critical, given that particularly local governments perhaps will not be able to raise funds as easily as they did through property sales and such. So there has to be a replacement for that revenue. So that revenue will help. And I think that revenue then can be turned around and used in terms of executing on policy towards this idea of shared prosperity. So it'll have some impact in terms of inequality. I think the biggest impact, though, is simply diversifying sources of revenue for government, both local government and for national government.
And will it help manage some of the excess in the real estate market, especially on the residential side, Steve? And to what degree will it help improve the credit profile of some of these developers in time? Yeah,
in a sense, I think it helps to perhaps, I don't know what the right word is, normalize the residential real estate market, in that it may take some of the speculation out of the market and truly make it more of a market based on demand for a place to live rather than as a investment vehicle. And if that's the case, it will slow the property market down, but then the property market should be on a better pace in terms of a slow and steady growth to match demand within the country. So I think overall it's a good move. It does work to create demand that's more in line with what one would expect.
Yeah, but Steve Martin here. Good to see you again. The timing of it, though, I mean, it's probably not overstating it to describe this property tax, at least even the trial, as potentially the biggest change in Chinese property in about a generation or so. And the aim of it, of course, yes, to displace or replace fiscal revenue. They can't sell land, so won't tax owners, etc. I understand that. But the other, and I think intended consequence, is to quash property speculation. I get that as well. But at a time when you know yourself, new construction is slowing, demand for housing is slowing, property price appreciation has started to moderate here. The risk is, I mean, it's only a trial now, I know, but if they roll it out nationwide, could this not put the entire kibosh on property and tank the sector, which is worth a quarter of the Chinese economy?
Yeah, there's a lot of risk involved in this move right now. And in fact, it is a little bit difficult to understand why, in a sense, so many changes seem to be entering into Chinese policy all at the same time. You know, whether it be with the residential real estate market, whether it be with the tech industries changing broadly the regulatory environment in China. It seems a little bit risky to be entering into all these changes all at the same time, that the economy is trying to emerge out of the pandemic and maintain some steady growth as a demand for goods is weakened by the supply chain constraints and such in China. There's a lot going on, and it is a little hard to understand why these aren't, in a sense, picked off one by one. Take it slowly, do some experimental changes one by one, and see how things go. It is a little bit hard to understand why so many changes happening all at the same time. Hard to understand what the individual impacts of each one might be when there are so many things going on at the same time.
Indeed, yeah, and into a slowing economy as well, because as you note in your latest Asia Pac update, Steve, out of Moody's Analytics, of course, China's economy, you're thinking it's going to slow down to 8% growth this year, 5% next year, and this is going to be a situation where the growth model in Asia is sort of turned on its head. It's usually China leading the way, but in this case, China is likely to be tail end Charlie, and Southeast Asia is going to be in the lead. No?
It is changing. You're absolutely right. We know the third quarter was a very, very weak quarter in China, and I have to think that the fourth quarter is going to be similarly weak, given all the issues in the property market and the other parts of the regulatory environment in China. Southeast Asia is beginning to open up now. The COVID wave has finally eased in much of Southeast Asia, and already many of the movement restrictions have already been eased. And so the domestic economies will finally begin to open up. We'll see some demand from households for goods and services in just about every country in Southeast Asia. And that will add to the fairly good export-based parts of the economies in much of the region as well. Much will depend on what happens in terms of demand in Europe and the U.S. These are going to be the primary drivers of the global economy over the next, 3, 6, 9 months or so. There was some fear in the U.S. that things were slowing, but it looked like the labor market is beginning to improve. Just the latest monthly numbers are looking good in terms of the labor market, and so my guess is that will continue to be the case. And export demand to the U.S. As well as to Europe will help buoy the Southeast Asian economy. So, yeah, things turned on their head a little bit. Southeast Asia a bit stronger than China, or at least accelerating. Korea and Taiwan still doing well with their export bases, and China slowing, and Japan also being a bit slow, given that their manufacturing economy is more tied to final products, mostly automobiles, which of course will be held up by the semiconductor shortage as well.
Yeah, Steve, and even laggards like, say, the Philippines and Thailand, they are going to be able to make back everything they lost in terms of output by the end of next year, I know you think. So, I mean, it's potentially a good sign. One caveat, though, and you're noting it yourself, and I don't think we can overstate this. This is the scenario you're painting, barring another wave of some new variant of the coronavirus, which we don't know about yet. I mean, that's a big if.
Well, that is a big if. I think we almost have to assume that there will be some kind of a wave of the coronavirus. We don't know if it'll be a new variant or what, but it's hard to say that we're at the end of this right now. So the key factor is that the rate of vaccinations will continue to accelerate. All of the countries of Asia have been accelerating the pace of vaccination, and I think as things go forward, that will only get better. I think, too, that governments are learning to deal with COVID without always having to institute some of the strict lockdowns that they have in the past. And our assumption is that if there isn't a wave, one, that wave will be muted by the higher vaccination rates. Two, governments will be a little more ready in terms of having their public health systems ready to go and handle the system, and also be selective in the kind of movement controls that they put into place.
Indeed, yeah. Fingers crossed. Listen, Steve, got to go. Great to talk to you. Thank you for your time this morning. Keep safe. We'll do it again soon. Steve Cochran there, Moody's Analytics, joining us live. All right, now, one by one, countries have started unveiling plans, how they plan to lower emissions ahead of the crucial COP26 meeting in Glasgow in Scotland. The latest One Squawk comes back after this. Welcome back. As we approach the UN Climate Change Conference kicking off this Sunday, China has come out with measures to achieve its carbon emission goals as well as more specific targets. The Central Committee and the State Council both want renewable energy to make up a fifth of total energy consumption in China by the end of 2025. That will rise to 25% or a quarter by 2030 and to 80% by 2060. Now, in order to achieve that, China says it will ban new oil refining and energy-intensive projects. Controls will also be applied to coal power industries. Beijing hoping to bring our carbon dioxide or CO2 emissions per unit of GDP down by more than 65% by the year 2030. Meantime, Saudi Arabia says it'll invest more than $180 billion to try and reach net zero carbon emissions by 2060. Crown Prince Mohammed bin Salman, MBS, explaining how the kingdom would reach that target in a pre-recorded message Saturday. Take a listen.
This initiative means to change the mix of power in the Kingdom of Saudi Arabia, to reduce the consumption of power, to increase the efficiency of production, and to invest in new energy sources like hydrogen. Also, we announced the union of the Kingdom to the International Pledge of Methane, which targets to reduce the international emission of methane by 30%.
Bahrain, meantime, also announcing a goal to reach net zero carbon emissions by 2060. Shri.
And over in Australia, Liberals and the Nationals have also reached an agreement on their net zero plan. Will Caloris has more from Sydney. Good day, Will. Just in time for COP26, I would hope.
Yeah, pretty much that's exactly what it is, Sri. And basically, the Liberal Party, so the Prime Minister Scott Morrison, the majority partner of that coalition, almost had the Nationals almost snookered when it does come to these talks. So what the Nationals have done is they've agreed in principle to supporting the Net Zero 2050 plan, and what they're hoping for and what they've addressed when it does come to these negotiations is trying to ensure that agriculture is ring-fenced from any kind of tangible and I suppose impact that is going to be negative when it does come to the raft of farmers here in Australia that do have, I suppose, some concerns about Australia when it does come to these net zero 2050 targets. It does have to be said, though, that when it comes to Australia, there isn't going to be necessarily any kind of legislative instrument when it comes to meeting these targets, but rather it's just a plan, a guideline, I suppose, a framework for Australia to meet net zero 2050, and that's what the Prime Minister, Scott Morrison, is going to be taking to the Glasgow summit. So it isn't necessarily, you know, something that you could say is a tangible process. We are going to get details of how they plan to get there and, I suppose, some enhanced targets for 2030. But the key there, Marty, is the fact that it's not necessarily going to be enshrined in legislation. So it's more of an ideal as opposed to it being something that the government has to follow to the letter.
Got it. Okay, thank you. Will Caloris there live down Sydney side. Still ahead on Squawk this Monday, we'll take a look at the risk factors for FX this new trading week. Rod Cantrell, NAB, the NAB, National Australia Bank, joins us when Squawk comes right back after this. Welcome back, Monday on Squawk. FX currencies, the major pairs and crosses shaping up like this early Asia as we embark on a new trading week. DXY, top of your screen, heavily euro denominated, 93.630, $1 yen, 113 and a half or thereabouts, and the Australian dollar right at the bottom there against the U.S. unit, 74.67. Rod Catrell, senior currency strategist, NAB, joins us live down Sydney side. Rob, good to see you. Hope you're keeping safe where you are. So a bunch of data out this week, but I think foremost are going to be GDP or growth numbers out from the U.S. as well as from the Eurozone, which are going to give us an indication just how bad Q3 was in terms of growth. In terms of the price action, do you think FX has it right?
Well, it's a great question. There's been quite a bit of excitement on the decline of the US dollar since late September. And I suppose to your question in terms of the GDP numbers, we do expect a relative softness in the Q3 GDP numbers from the US. But I think what the market will be looking is looking through that and see what Q4 looks like. And in that sense, the more we look at it, we think that the US economy it probably stands to outperform others, particularly Europe, the UK, and even China for that matter. So the dollar weakness that we've seen at the moment, we will see it sort of extending, if you like, towards the end of Q4.
Okay, so where's DXY headed?
Well, we still think that because of these uncertainties, particularly from the supply chains and what we think the market hasn't yet fully priced is the slowdown coming from China. The struggles from the property sector have not yet been truly reflected in the data. If anything, the decline in steel prices probably tells you of what is yet to come, and that will be important for commodity prices. So our sense is that FX markets will still be sort of range bound, if you like, this year with the weakness that we're seeing in the dollar, showing a bit of a turn, and the dollar ending the year a little bit stronger, as that weakness that we expect to be reflected in the data coming from China will start weighing on commodity-linked currencies like the Aussie and NOK and the Kiwi as well.
Rod, Turkey and Erdogan's unorthodox policy, do they risk sending emerging market currencies into a tailspin again, or is this a country-specific issue confined to the lira?
I think it is a country-specific issue, but if anything, the price action last week is a reminder that when you see those big movements, it does have implications for EM markets, and you saw other currencies being affected by it. So it will be a source of volatility, but we don't see it as sort of a source that will change the trend in direction for EM and growth-sensitive currencies like the Aussie as well.
And where does this energy price spike, and you alluded to it earlier in the conversation, and possibly the risk of $100 a barrel oil this winter leave the oil-sensitive currencies like the Norwegian krone, Russian ruble and the loonie?
It's certainly providing them support, and it also extends to even energy currencies. LNG, for that matter, in Australia is showing to, and coal has been well bid, and it's actually provided a nice uplift, like support to the Aussie dollar. So that energy crunch is important. I think that the risk of the energy crunch is the weather, in terms of how severe cold the winter will be both in Europe and in China, and that will challenge that limited supply. So it remains to be seen how it will play out, but at the moment it's certainly not just an inflationary story. It's actually an output story. It's restraining the ability of China to produce more, and for that matter, Europe. And a cold winter could certainly exacerbate that and support energy-linked currencies for that matter.
Rod, back to China. Where would you put dollar China 3 to 6 months out, given the fact that the macroeconomic prospects are looking increasingly challenging and we are looking at growth rates of just above 5% in 2022?
Well, the interesting story of CNY is that it's moved below the 640 mark despite this backdrop of weakness. It plays to, the PBOC argument or mantra, if you like, of stability, both in credit and in currency. We see that dollar CNY is probably like a 60-35, 60-45 currency over the next 6 months. And it will be pivotal not only what happens to activity in China and how the consumer reacts to that, but the fortunes of the US dollar, because to some extent, it really is a reflection of a low beta movements to the dollar. So to answer your question, later in the year, we think we'll be above 640 rather than below 640.
Okay, we'll watch and wait. Rod, quickly, dollar yen, 115 to break. Is that possible?
Well, the more we look at it, we think that not yet. The risk to that view will be that we see a huge spike in U.S. Treasury yields and we break 180 and end the year at 2%. But at the moment, the more we look at it from a valuation perspective, from fundamentals, we struggle with the idea of dollar yen breaking above 115, and we've been advising to lean against it every time we get close to those levels.
Rod, very quickly, AUD, can we be a bit more constructive on the currency given that Australia is starting to open?
Certainly, that is sort of the great news that we expect, and I think there's very good reasons to expect a significant rebound in activity. But in terms of what is already in the price, it's quite aggressive. We've seen the market already pricing a cash rate of 0.5% next year. So we think that sort of, if you like, positive outlook for the Australian economy is already in the price. And if anything, we will expect volatility to come from RBA, continue to push against it, given that we're not there yet in terms of the targets for full employment, wages growth, and so on. So it's good news, but a lot in the price already.
Absolutely, and this virus is evolving and remains highly dynamic. Rod, thank you very much indeed for those comments. Rodrigo Catril there off NAB. Coming up next, China Evergrande may have just removed an overhang after reportedly making a key interest payment due to foreign bondholders. We'll talk about the road ahead for the property developer with JP Morgan's Joyce Chang after this break. Welcome back. Let's take a look at shares off Evergrande closing higher in Hong Kong on Friday after the company appeared to have averted default in the 11th hour. Reuters reporting that the company wired $83.5 million to cover the US dollar coupon payment it missed last month. But Evergrande faces another imminent debt deadline. Meanwhile, despite its liabilities totaling more than $300 billion, the company says it resumed work on 10 projects on Sunday. Let's get more on this now with Joyce Chang, Chair of Global Research at JP Morgan. She joins us from New York. Joyce, thank you very much indeed for your time. First of all, when you look and take a step back at credit spreads, what are they telling you about how investable or otherwise China high-yield property is?
Well, look, China high-yield property default rates are going to move higher. We're already at a record high, but we do think that Evergrande is still headed on a collision course for restructuring. It's not just this payment. They have payments due before the end of the month, $338 million due before the end of the year. But there's $12 billion of debt servicing payments due in 2022. So I think you're going to see a default rate that's going to rise if you include Evergrande to north of 20%. That's a record high. So I think the market has priced in a lot, but there's still more stress in the system to come.
Still more stress in the system. Then, Joyce, does this mean that Beijing has got a handle on this situation and contained the fallout, or does it still risk becoming a systemic problem?
This is not a systemic problem. I mean, if you take a look at the total loan loss for Evergrande and the total size of the property development loans, which is about 7% of loans, and what the loan losses are for the first half of the year for banks, this can very well be covered. But I do think what you're going to see is a state-guided solution. And we've seen some small sales, but the big question is how these sales are going to be handled in 2012. So this interest payment does show you that I think it's a state-guided solution. It's something where the authorities want to be very careful that they don't have contagion to China or globally, coming from this. So it's how the asset sales proceed that we're really watching from here. But we do see a default rate that is going higher. This is a pleasant surprise on the coupon payment, but it doesn't change our overall view, given the debt burden that Evergrande has, that you're in a restructuring situation.
Yeah, Joyce, good to see you again. Martin here. So, yeah, they've got more bills coming to you, right? As you suggested, $340 million worth of bond payments the rest of this year. Next year is even more worrying, $6.1 billion. So the good news is the government, you think, and I think seems to be a consensus, they are going to be able to ring fence this. But here's the thing I'm trying to figure out, and we've been talking about this for a couple of days now. Why are they at the same time as this is going on trying to resurrect this idea of a property tax? I understand it's just a trial right now, but, if Xi Jinping has his way, it could roll out nationwide, and it seems like at the worst possible time.
I think what you have to understand is that China has longer-term goals in common prosperity, 2035, 2049, and they're going to separate the macro and the industrial policies. And so the property taxes, in part because for the first time, they're talking about affordable housing. Do you put taxes on things that are held purely as investments? If you're trying to get to that goal of common prosperity and talk about affordable housing for the first time in China for the middle class. So it's a very fine line that the government is walking right now. Like, they don't want to jeopardize the housing market and housing prices. That's still about 60% of what household wealth is, but they also do want to send a clear message that what they're trying to do is achieve some longer term goals. And this does mean that they're separating the macro and some of the industrial issues, which used to be married to each other as they set policy going forward. And property taxes is part of that.
So here's the thing. I mean, if you're, newly minted in the middle class in China, and this happens and it gets rolled out further, the property tax I'm talking about, it could mean much better affordability. You can actually get on the whole middle class ladder and start climbing with billions of other Chinese, right? The thing is, though, what I'm trying to figure out is with regards to investors, let's say including your clients, high net worth individuals who are holding Chinese property developer paper, i.e. Asian high yield bonds, what happens to them?
Well, I think a lot of this is already priced into the market. I mean, we would be neutral here. I mean, a lot got priced into the market very quickly, but you're not done with the restructurings and you're not done with the default rate. So we're at a record high default rate right now, north of 6%, but that's probably going to 20% when you put Evergrande in. Now, Evergrande is priced at this point, but this is part of a larger agenda. And it's not just the property sector. I mean, when you look at common prosperity, it's affecting the new economy. I think it will affect, education, transportation, healthcare as well. I think the bottom line is investors have to understand that they are taking some policy risk when they take a look at China, because macro and industrial policies will not always be aligned given what the government's longer term objectives are. And these are longer term objectives. I mean, we're looking to 2035, 2049 for what the government wants to achieve. But even in this quarter, we've taken some dramatic downward revisions on growth. We have growth in China in the third quarter of the year, by our estimates, contracting more than 3%.
Joyce, but just to be absolutely clear here, we do not throw the baby out with the bathwater, do we? Surely there are property developers with strong balance sheets, with sounder credit profiles that are well positioned to really benefit from this official mandate to build more affordable housing.
Yes, no, I think that is absolutely the case. But I do think that you're going to see a lot of this tightening of the financial regulatory system, continue into the remainder of the year and to next year. And I don't think that you've seen the default peaks. And when you look at the size of the debt that Evergrande has due in debt servicing, I mean, there still is more to come. So there are going to be opportunities here. And we think there are opportunities in China right now. But I would just be cautious on saying that we've actually seen all of this play out at this point in time. And I do think that investors are taking a very close look at this. They're asking, what is it that we can buy right now? One thing that really has stood through all of this has actually been being in the Chinese government bonds, which still have the yield differential, the stable currency, the entry into the index, which has helped it. That's one structural trade that I think through all of this really has been not affected much at all.
CGB, so Govey's interesting. Even with Chinese high yield spreads at record wides, and what I really need to know is this default rate, China high yield, real estate specifically, north of 20%. Is that priced in yet or not?
Well, I mean, look, China high yield bonds are like, half of the market right now. So a lot of that has been priced. I mean, these price moves have happened very quickly. But I wouldn't necessarily say that they're going to move up anytime quickly either when you just look at the debt servicing that lies ahead. So I don't feel a need to say this is the moment that you need to step into this, because I think you still need to see how they proceed with the asset sales. And there's still more defaults that are likely to come given what our forecast is on the default ratio. But what we have seen is that, it's not systemic, and that for the Chinese government bonds, even though we saw a slowdown in inflows, we've still continued to see very positive, consistent inflows, which makes sense in just the yield environment we're in. Even with rising treasury yields, I mean, you are getting paid for holding the Chinese government bonds.
Joyce, can I push back on that a wee bit? To what degree, because it seems to be a perfect storm that China is facing right now in terms of the macro conditions, to what degree has the regulatory fallout, the Evergrande fallout, the energy shortages affected investor perceptions, and where does that leave the flows picture in 2022?
Well, we have taken down the growth forecast quite markedly. I mean, we have growth just below 8% this year, and next year we've taken growth to below 5%. And that's very meaningful for the global economy. I mean, every percentage point off of Chinese growth is about half a point off of global growth. But what I would say is that still, these are pretty strong growth numbers. 5% growth, 4.9% growth next year is still a very strong number. You still have the yield differential. I think the currency is going to remain stable. One way in which outflows had been leaving China had actually been through a lot of the travel and tourism. That was sort of in the Arizona emissions line, and you don't have that right now because of the quarantine. You've had a lot of stability in the currency, and you still have China going into the mainstream indexes with FTSE starting in October. So we have seen inflows have slowed to China, but if you take a look at dedicated emerging markets mutual funds, for about 85% of the inflows into all of emerging markets, local currency year to date has been to China.
Okay, it's a good, interesting stat there. Joyce, thank you. Appreciate your time. You keep safe where you are, and we'll do it again very soon.
Joyce.
I hope. Joyce Chang, JP Morgan, joining us live. Coming up on Squawk this Monday, Australian markets open up top of the hour. We are T-minus about 11 minutes or so, 10 and a half, call it. We'll set you up for Monday trade down Sydney side when Squawk comes back after this.
Britain's biggest bank, HSBC, to release Q3 results at the midday break. We'll break those numbers and speak to Ewan Stevenson, Bank Group CFO, on the back of the earnings. PetroChina, WH Group, China's big four banks, and Sinopec are among other blue chips reporting this week. On the economic calendar, we get Taiwan industrial output today, Hong Kong trade data tomorrow, China industrial profits on Wednesday, and Taiwan Q3 GDP on Friday.
Earnings season continues this week with Michelin, HSBC, and Facebook the main highlights today. On the data front, Germany's IFO business surveys for October will be closely watched. Finally, investors in Europe will be bracing for a fresh monetary policy decision from the European Central Bank on Thursday.
A huge week of earnings. America's biggest companies are reporting, including Apple, Amazon, Microsoft, Facebook, and Google's parent Alphabet. 1/3 of the Dow are out with results, among them Boeing, Coca-Cola, 3M, Visa, and McDonald's. If that's not enough, marquee names like GM, UPS, Starbucks, and Twitter are also on deck. On Wednesday, Rent the Runway is expected to go public. It'll trade on the NASDAQ under the ticker RENT. The fashion retailer could be valued around $1.5 billion upon its debut. However, the company has not been profitable the past 2 years. And Friday marks the final trading day of October. Stocks have rebounded from a rough September. The Dow, SP 500, and NASDAQ are back around record highs. And with the good start to the fourth quarter, all three indexes have strong double-digit gains this year with just 2 months to go.
Italy has called off talks for UniCredit to take over troubled Monte dei Paschi, or MPS. Italy has been looking to privatise MPS after a $6.3 billion bailout in 2017. The talks collapsed due to differences in valuation and the types of assets to be sold. The Italian Treasury reportedly valued MPS's assets at between 3.6 to 4.8 billion euros, but UniCredit said they were only worth 1.3 billion euros. Rome will now look to extend the deadline with the EU for the sale of MPS. And several updates from Chinese EV maker XPeng at its tech day yesterday. XPeng-backed HT Aero launched a new flying car that can also be driven on roads. The car is not yet commercially available and should be rolled out in the year 2024. Both companies also revealed the latest version of their X-Pilot Advanced Driver Assistance Scheme. That semi-autonomous driving system will be rolled out in some Chinese cities as early as next year. Martin.
Wow, okay. Now, Chinese conglomerate HNA moving forward with their restructuring after creditors gave it the go-ahead. That's according to a court statement posted on HNA's WeChat page. The group was put in bankruptcy administration back in February after liquidity concerns were raised. HNA is expected to receive close to $6 billion in investment after restructuring, which will go towards funding the group's 11 units, including Hainan Airlines. And PTM has reportedly got the go-ahead from regulators for India's biggest ever IPO. According to Reuters, the Indian fintech will be valued at $2.2 billion and is likely to list at the end of this month. PTM expanded rapidly after New Delhi banned high-value banknotes, boosting demand for digital payments. It's now diversified its services to include deposits, remittances, and also insurance. All right, back to markets. Sydney opens up top of the hour, T-minus less than 4 minutes, about 4 minutes, in fact. Swing down Sydney side. And, Will, of course, this is an M&A Monday. Origin selling a 10% stake in Australia Pacific LNG, $2 billion. But Telstra partnering the Aussie government, buying Digicel, $1.6 billion. Smaller value amount, but a spicier deal.
It is, but it's actually the same because the 1.6 billion is in US dollars. So you're right on the money, Marty. But in terms of this Digicel South Pacific deal, this one is incredibly interesting and has been for quite some time. Everyone knows the Digicel owner, Dennis O'Brien. He's that flamboyant Irish billionaire, and there has been a lot of commentary over, say, the last 18 months that he was intentionally kicking the tyres with China Mobile and other major Chinese telcos when it does come to these South Pacific assets in order to generate this kind of a deal coming the way of the Australian government and Telstra. So 1.6 billion US dollars. Telstra is actually going to be kicking in 270 million of that US dollars, but they're going to hold all the ordinary equity, and then there's going to be a further 1.3 billion US dollars that's actually coming via the way of some government entities like the financing corporations, and it's going to be in the form of debt instruments and securities and the like. But what this means is that it's, I suppose, viewed by the Australian government as safer, ensuring that the telecommunications networks over there in PNG, because you've got to remember you've got undersea cables and the likes, aren't necessarily infiltrated by the Chinese side. So that is really what drove this deal to take place. But it'll be interesting to see how the market does react to this deal. You're talking about the South Pacific unit of Digicel having an EBITDA last year of around about $270 million. They're thinking in terms of medium to long-term capex, having to spend around, it's a 15% ratio of capex to sales moving forward. So all of that, how the market reacts is going to be incredibly interesting. We're also watching that Origin Energy deal, 2.1 billion Australian dollars for a 10% stake in that APLNG, and we'll have more on that in the next hour. But don't go anywhere. We're going to get you across the Sydney Open, plus all the market action from across Asia when Squawk Box returns. Stay with us.
Good Monday morning to you. 7 a.m. here in Singapore, 8 a.m. in Tokyo. I'm Sri Jagaraja with Martin Sung. Let's get you across today's headlines this Monday.
Good morning, Sri. Let's do that. Asia is working with a mixed lead from Wall Street Friday. The NASDAQ fell. The Dow finished up at a new record high. Meantime, U.S. House Leader Nancy Pelosi says she hopes to hold a vote on social spending and infrastructure bills later this week. And down in Australia, it's M&A Monday there. Origin Energy selling a 10% stake in Australia Pacific LNG. Price tag $1.5 billion US dollars. Telstra partnering the Australian government buying Digicel Pacific. Price tag $1.6 billion US dollars. And China Evergrande apparently averting default after reportedly making a coupon payment and says it has restarted 10 property projects. Let's get right to markets as we always do, top of every hour, and start with U.S. futures. They are up and running and rolling. And at this early juncture, handicapping what looks to be a weak start to a fresh trading week when Wall Street gets back up and running tonight, Asia time there. And this is despite the U.S. House, as we headlined, looking to vote on spending bills later this week. Meantime, the lead again from Friday, mixed. Fed Chair Jay Powell saying that inflation is proving stickier than he thought. Take a listen.
The risk is that ongoing high inflation will begin to lead price and wage setters to expect unduly high rates of inflation in the future. And if we were to see a serious risk of inflation moving up persistently to higher levels, we would certainly use our tools to preserve price stability while also taking into account the implication of our maximum employment goal.
So it sounds like a major concession, or if not acknowledgement at least. Tokyo starting to trade top of the next hour. Less than 60 minutes to kick off there. CME Nikkei futures handicapping what looks to be a softer down start. Dollar yen 113.5 or thereabouts. New Zealand way down south. Wellington's been up and running for about 2 hours. Looking soft, 1/4% at below the line. Kiwi New Zealand currency at 71.49. And Sydney has just joined the trading day. About 2.5 minutes in, Will Kalors were, well, by the numbers, looking fairly decent.
Yeah, and we're probably going to end up a little bit more decent than that, but perhaps not by too much, because materials and energy are driving the gains in the early run, particularly the iron ore miners. And once, I suppose, Rio gets open, we should see a little bit of a kick up for them at the same time. But there has been a raft of M&A this Monday. It's a record-setting year for Australia when it does come to M&A, and the hits just keep on coming. Firstly, that one that you mentioned in the headlines, Origin Energy selling a 10% stake in its Asia Pacific LNG development to EIG Partners, a huge global energy firm, for 2.1 billion Australian dollars. But they are still retaining that 27.5% stake. ConocoPhillips is actually the majority holder of 37.5%, but Origin Energy are going to be maintained as the upstream operator of that asset. Basically, they're trying to unlock a little bit of value, but to be fair, Origin Energy has been absolutely creamed over the course of the last, let's say, 2 years or so because of the issues that we were seeing during COVID-19. So this basically allows them to unlock a little bit of capital for developments moving forward whilst maintaining this strong stake in this actual development. And considering the run in the LNG prices that we have been seeing, they're obviously going to be benefiting from that. Also, Telstra has a huge deal when it does come to Digicel South Pacific with the Australian government. Now, it's a $1.6 billion US deal. The government is actually kicking in $1.3 billion in terms of funding this transaction. It's going to be $270 million US that Telstra is on the hook for. But it's basically Digicel's assets in the South Pacific, which in reality is primarily Papua New Guinea. There was a lot of chatter for a very long time about a lot of Chinese telcos kicking tires with the Digicel owner. This obviously ameliorates that. Telstra is going to be the operator of the Digicel South Pacific, but it has to be said, Marty, quite a profitable business. It did around about $233 million in EBITDA just for the last financial year alone.
Well, fantastic report. Thank you very much indeed for that. Now, China has started trials for a new real estate tax as part of President Xi Jinping's common prosperity policy. Sam Vadas is here with the details. Good morning, Sam. Now, we know that Beijing never does anything big bang style. It's always incremental. It could be 5 years before we see these taxes take effect.
Yeah, good morning to you, Shri. That's absolutely right. This will take effect once the details are actually released by the State Council. But I think it's important to point out that this has been talked about for a number of years now, since the early 2000s. It has faced resistance in the past over concerns that it could actually stifle this housing demand in China and certainly these prices. But it is very much firmly back on the table now after President Xi Jinping backed the idea. It really is seen as necessary, as these housing prices have skyrocketed more than 2,000% since the 90s. So this could certainly help cool some of those prices. But perhaps more importantly, there has been some suggestion that it could bring in some much needed revenue for these local governments, which would certainly help this common prosperity goal here that we're talking about, because of course the property sector in China has largely been seen as an area that magnifies the wealth gap. So this could help that drive. In terms of what this looks like, the tax will be collected from residential and non-residential properties as well as landowners, but not rural land. And the scheme, as Shri pointed out, will last for 5 years from when the State Council releases the details. Authorities haven't released or said which areas could be up for this pilot scheme, but there has been some speculation online. I've seen some analysts on Weibo suggesting this could be Beijing, Guangdong, Zhejiang, home to Alibaba, of course, and Hainan Island, many of which are areas that really do have skyrocketing prices, and also the voices are much louder. But this has been described as one of the biggest changes in China's property market in around a generation. But of course, the timing is interesting. It does come at a very delicate time for this sector, given these tightening credit conditions and also these added concerns now about the potential contagion risk of everything that's going on with Evergrande. So we'll have to wait and see how this one goes, Marty.
Thank you, Sam Vadas. Meantime, Evergrande itself seems to have averted default, at least for now. This is after apparently wiring money to cover a U.S. coupon payment due back on Friday. But the company is not even remotely in the clear yet, though. Emily Tan with details from Hong Kong. Good morning.
Yeah, good morning, Martin. That's because there are still other payments that are due that the company is in a grace period for, and we look out to the next deadline, and that is this Friday, October the 29th, with the amount of $45.2 million due, and that is the bond interest payment that was due on September the 29th. So we wind back on Friday. We were reporting about a reported payment that was made in the amount of $83.5 million wired to a Citibank, which is the trustee. And so that basically would tick that box, so it wouldn't officially be in default. So we look to the next deadline, and as of right now, there are 4 other bond payments that are due. We're going to be continuing to watch all of that. It is little known about the company's ability to make payments on the next couple of bond interest payments, and we also know that property sales have been down something like 30% over the last 12 months. There is skepticism over Evergrande's capacity to be able to ride this out. But having said that, the company's chairman, Hui Ka-yan, being reported by Securities Times that they aim to make their company a primarily NEV business. So they're going to be shifting away from property into electric vehicles, and this to do so within the next 10 years. Property sales by that time will have been reduced to about $31 billion per year. You compare that to the over $100 billion that was collected last year. So keep an eye out on Evergrande shares. On Friday, it was up about 4.25%, but that was off the day's highs. It was rallying as hard as 10%. The NEV stock up 4.6%. Evergrande Property Services up 1.7%, $4.79. Martin, it's back to you.
Thank you, Emily Tan live up in Hong Kong, where we also find our guest host, David Roach, back with us, president and global strategist, Independent Strategy. David, good to see you again. Good morning, and hope you're continuing to keep safe. This whole property tax idea, it's been around for about 20 years or so. They're resurrecting it. And the thing is, they've tried it in places like Shanghai and Chongqing, as you well know, and it did not have the intended effect. I mean, what do you think makes them think it might happen this time around, or do they have no choice because of lost revenue now?
Well, I think the context in which one has to put this is common prosperity, which is what President Xi Jinping has designed and decreed as being the next stage of the development of the Chinese economic architecture. So you can take it that the whole attitude towards wealth creation, towards the private sector, has changed. And within this, the big idea is, of course, that we create a lot of new, happy middle-class people who have affordable housing and affordable healthcare and affordable education, and are therefore happy citizens. And in order to do this, you need to make sure that housing is for living in. It is not for speculation or for investment, and that's more or less a quote from President Xi Jinping himself. So this idea has come up in what he has been saying several times in very recent speeches, declarations, commentaries by him. So it is not something which is going to be left to local authorities to put into practice or local governments. It is something which they will have to do because it is coming from the top, and therefore it will happen.
Okay, so yeah, it's one of the, I guess, beauties, if you want to call that, of a command economy, right? Common prosperity, common prosperity, good for the middle class. I mean, that is the intended constituency, the target, right? Crucially important for the Chinese Communist Party. On the other hand, with this property tax, are they also saying, as they are doing with Jack Ma and his ilk, you know, billionaires, look, if it hurts you, too bad. You can afford to lose that billion or two.
Oh, well, completely. I mean, look, it is a little unfair to say this is simply the sort of thing that happens in the development of an economy, which is a Marxist-Leninist economy and political organization, because after all, Martin, it happened in the United States once upon a time, long before you were born. You had the robber barons, the J.P. Morgans of this world, who behaved with impunity and exaggerated and sort of wealth effects. And this has come to an end in China because it is now a political liability. So it is, in fact, though it is decreed from the top and will happen from the top, yes, it is the end of the sort of robber baron period of Chinese economic development. And what we are saying is that to put it in a metaphorical sense, purely, of course, the really rich, visible people are decapitated, economically speaking, of course, only, and they end up by going on sailing holidays to Spain if they're lucky. But the economy becomes much more of a redistributive economy, which in a sense gives its profits and capital wealth in part to the state through taxation and controls, and the state passes it on to create the common prosperity of the middle classes. But the high-profile personalities of the capitalistic era, the idea that a black cat or a white cat doesn't matter as long as it creates money, which trickles down and lifts people out of prosperity, out of poverty into prosperity, that sort of black-white cat period is well and truly buried at the end of the garden, and I'm very sorry for the kitty cat.
David, if all of this is decreed from on high by Beijing, then are they going to decree how Evergrande is going to be restructured? And will it be restructured as a vehicle to generate more affordable housing? And if so, and if the speculators are going to be taken out of the property sector, does it make it more investable in the longer term for patient capital?
It might make more investment possible or attractive in terms of buying cranes and bulldozers, which will be creating the sort of affordable housing. But it makes the investment in the real estate sector, which was in a sense profitable, not so much because of its economic contribution, but because of its exaggerated economic rents. That is over. So essentially, you're choosing the caterpillars of this world rather than, and I don't mean the insect, I mean the bulldozers of this world, rather than the kind of high-profile tycoon-controlled organization. So it's a different type of investment. It still results in economic growth. It still results in housing. But the way you invest in it is very different. And I would add one more thing, that the need of China for foreign capital in order to achieve this common prosperity is much reduced. I think, of course, the state will decide what happens to Evergrande. And I think we won't probably even remember its name in 2 years. But I doubt very much if it's going to, suddenly pop up again as one of China's great big electric vehicle producers because there are plenty of more competent companies in that space.
So in other words, if I understand you correctly, David, high yield, high risk property sector, that's out. That's going to be officially mandated as yesterday's news, and that will be taken away. And what we have in place over time will be a more steady dividend yielding sector, a safer bet, because it's been backstopped by the state, yes?
I think that's right. I think the excessive economic rents associated with speculation and capital appreciation of houses, kind of the whole supply chain of getting cheap land leases from local authorities who got money, then piling on bank debts, creating an overly expensive housing estate, and then flogging it at high prices to individuals who then had to also have high mortgages and pay for the development of the housing. That model is pretty well out of the window. I think what we're going to see is the development of a much more moderate, modest type of housing, because China will need housing even though the population is declining. They want more babies, so you've got to have them someplace, so you need more housing. But it's going to be much more of a social type housing. And I think the value added in it will be in the actual construction of it rather than in the flipping of capital values from one sector of the economy to the other, from the back end to the front end of the economy. I think that's the new model.
Yes. And ensuring social stability is at the heart of this policy. David, thank you for that. We'll get back to you later on in the programme. In the meantime, we're going to squeeze in a quick break. We're back in 2 minutes. Let's get back to David Roche from Independent Strategy. And David, let's just pick up on China once more and the regulatory uncertainty as it applies to technology. How long do you think this is going to drag out and last? And where does it leave just how investable or otherwise the sector is?
Well, I think, again, you're looking at a rather new type of business model for the sector. How long will it last? Well, it will last for as long as it is necessary for the Chinese Communist Party to assert its control, not only over the capital in the sector and what it is actually doing, but also over the data in the sector, which the Chinese authorities obviously want to control. for their own purposes and to limit the development of companies which could look like Facebook or Google within the Chinese context. They don't want that to happen. So you have three aims. One is control the excessive economic capital wealth being accumulated by the owners. Two is to control the data. And the third is to make sure that you're not setting up monopolies like Google and Facebook in the West. So to achieve all that, Sri, is not all in a day's work. It's all in at least 2 to 3 years work before we get to a new business model, which is going to be something we have never seen because we don't have properly controlled tech giants in the West. So China is going to create something new. Will it be investable? Yes. Will most of the investment in it be controlled or control the companies domestically within China? Yes, of course, because that's part and parcel of what they're trying to achieve. So a brave new world, which for once we have not invented.
Right, and it just seems that the regulatory overhang is heaviest on China. So where does that leave Baidu, Ali, and Tencent compared to their counterparts in North America, the FANG stocks? Are the FANGs, in fact, the better investment proposition from a regulatory arbitrage point of view?
The answer is probably yes, because I think while the Europeans may get a handle, and in fact, the Chinese regulations which are being published are three major laws, which are extremely complicated to discuss, but they're there. They're actually based more or less on the European protection of consumer data, with a big exception that in Europe, the state does not have access to that data, whereas in China, it is specifically manifested. But what does this actually do? Yes, it limits the activities of a Google and a Facebook. In fact, it damages the business model because you can no longer use and sell data at will if you're one of these companies. But will this spread to America? I doubt it very much because the Americans will try and they'll huff and puff in Congress as we're getting used to. But we've got to remember that these giant corporations, which are in many respects monopolies or more or less monopolies globally outside of China, they are American. They are US companies. They're not European companies, so it's much easier to bash them and control them. They are US companies. Will the US really come to terms with this and limit Zuckerberg? I doubt it very much. But will they try? Yes. Regulatory arbitrage, I would say marginally in favor if you're greedy and don't care about society in investing in the Western versions of the Googles and the Facebooks, but it's a pretty narrow case. Worldwide, the pressures are going to grow.
David Roach, you are prolific in terms of cranking out research. One thing that jumped out at me when I was scouring the pages and pages of stuff from you, you think that President Biden is going to be a one-term president. You think that Trump is going to return. Does this assume that his new media brand is going to be successful and that with this SPAC that he's attempting, he's going to make billions?
Well, now, Martin, two things. First of all, prolific writers, as you have named me, are normally mediocre thinkers. That goes for poets as well as strategists. So maybe that's a caveat. But having said that, the reason why I think that Biden is a one-term president is simply because he's really of mediocre intelligence and competence. He's the wrong stage of his life, and he's making enough mistakes to become a serious liability in terms of U.S. policy and its perception around the world and at home. And I think by the time we get to the next presidential election, the piper will have to be paid for the excessive fiscal spending and so on. So I think the likelihood is he will not be reelected, and you only need to shift 10 percentage points of the vote. So who will it go to? Well, the Republican Party doesn't look like it's going to name anyone else, so it'll be Trump.
Oh, goodness. Okay, listen, hold that thought. Controversial, we'll pick it up when we continue with the David Roach Independent Strategy after this quick break on Squawk. Welcome back. Monday here on Squawk Asia. Let's take a look at Asian markets and start way down south of New Zealand. It's been up and running Wellington for more than an hour and a half now, and it's still looking soggy, down to 0.25% with the New Zealand currency. The Kiwi at 71.48. Sydney is about coming half an hour into a fresh week of trade. It is looking, solid, up about 0.5% there. The Aussie AUD, 74.66. And we've got Tokyo, the big fella, opening up trade in a little bit more than 30 minutes' time. CME Nikkei futures are handicapping a slightly softer start. Dollar yen, 113.60 as we speak. We'll continue with our guest host, David Roach, in a bit of strategy. When Squawk comes right back after this. Welcome back. Monday here on Squawk Asia. Time check, bottom of the 7 o'clock hour, 7:30 Hong Kong, Singapore time, which means we are less than 30 minutes to kick off up in Tokyo. SGX Nikkei futures are handicapping, tipping a slightly negative start, looks like. Dollar yen, 113 2/3 as we speak. After a barrage of Wall Street investors sounded the alarm on inflation last week, well, now we have Fed Chair Jay Powell conceding that he is now more concerned about rising prices. Take a listen.
With these supply constraints and shortages, and therefore elevated inflation, they're likely to last longer than previously expected, likely well into next year. And the same is true for upward pressure on wages. But it is still the most likely case that as supply-side constraints abate, as they eventually will, and as job gains move back up, inflation will move back down closer to our 2% goal.
Chair Powell maintained that while emergency bond buying will be pulled back, or pared back rather, it is not time yet to raise interest rates. Meantime, Square and Twitter CEO Jack Dorsey tweeting, of course, that he sees inflation escalating around the globe and that hyperinflation is going to change everything. It's happening, his words. Mind you, Dorsey is a Bitcoin advocate, and he says that Square is planning to get into Bitcoin mining. So a bit of self-interest there. All right, back with David Roach, Independent Strategy. So Chair Powell, Jay Powell, doing a bit of a U-turn and finally conceding, acknowledging what a lot of people, including yourself, David Roach, have known all along, that baked-in inflation is just that, baked in. This is not just a passing thing.
The poor man, sure. I mean, what you expect. central bankers, like diplomats, are paid to lie until the lie becomes so evident that they have to change it to a new one. And the reality is that, of course, inflation, like we all knew, is coming back. It's durable. It's being fed by a whole host of things, including monetary policy. But the main thing really is the inefficiencies and the mismatches of the post-pandemic economy. And while I don't for 1 second think we're moving to hyperinflation, though it's a nice argument for buying alternative assets like Bitcoins or a more intelligent version of Ethereum, the reality is that we are moving into a period in which traditional financial markets, bonds already, equities tomorrow, will be challenged by two things. One is the rising cost of capital, higher interest rates, higher bond yields, and also the fact that people generally ignore is that once that happens, you get greater cyclicality in the economy, greater cyclicality in individual stocks, which increases the risk. So the discount factor actually reduces the price-earnings ratio at the same time as the outlook for the economy becomes less certain.
So here's the thing. How come then, David Roach, we're about halfway through the third quarter earnings season stateside, and companies so far, they seem to have been managing to either maintain or even in some cases increase their margins at a time when people thought, look, there's only so far you can push the consumer instead of paying a higher price. And look, there's only so much they can cut costs, which leads to my bigger question. That is to push back against your argument for inflation. What about the structural drivers, demographics and technology? What about the cyclical drivers that companies have learned or rather been forced to as a result of the coronavirus pandemic to cut costs, become much more efficient with their labor, and certainly much more efficient with their use of plant and equipment?
Well, I'd say, Martin, there is a contradiction in what you're saying, which is very rare for you, which is that if you are going to cut costs and use labor more efficiently and use less of it and replace it with robots, then where does the consumer get the money to go on spending as he has been spending or she has been spending since the pandemic recovery started? And the answer is, of course, they got it out of excess savings. Well, they're absorbing and using and spending the excess savings. So what you get is you get all the pent-up savings being spent, you get the excess demand, and then you get a declining demand towards a trend growth rate, which is probably lower in macroeconomic terms than before the pandemic actually happened, because there is legacy structural damage to the economy. If that happens, then if costs are rising, as you described quite correctly, and go on rising, then essentially you get the squeeze on the margins, but it comes later because you are still in the period where your margins are backward looking. And they're looking back at when there was excess demand. Now you're going to be looking at the period when that excess demand evaporates. You decline towards a trend growth rate in the top line of companies and the top line of the economy. But unfortunately, the input costs to achieving even that do not start to decline. So then you get the margin squeeze, which is forward looking. And what we're talking about is backward looking stock market profits.
David, so we may not be looking at hyperinflation, but are we looking at a winter of discontent?
Well, everybody's discontented anyway. I mean, pretty well, since globalization started making things more efficient, but making the traditional workers poorer in developed economies and the workers in developing economies and poor countries like China richer, there's been massive discontent everywhere, which is why we've got populist politicians ruling countries who really should be confined to running a sweet shop. But that, in a sense, is where we are. And I think the winter of discontent is simply a continuation of the pandemic of discontent and the globalization of discontent and so on. Is it going to lead to revolution? Probably not. Is it going to lead to a sudden packing up of the consumer? Probably not. It's just the continuation of this grinding gray sort of confidence or lack of confidence in global economies, which is part and parcel of resuming a trend growth rate, which is actually lower than before the pandemic because damage has been done, whereas costs are going to be higher because damage has been done. And the combination of those two things is a rather poor environment for financial assets looking out. But having said that, I could have said that last week or last month, and look where the stock markets are. So maybe you should not listen to me after all.
David, back to the central banks, who are facing an utter dilemma, are they not? It's clear now that inflation is not looking transitory. How then do they respond? Because if they do tighten, then they stand to kneecap this tentative recovery.
I mean, that's an absolutely valid point. And if you wanted to put a point on the point, I'd look at the Bank of England, where the consumer is weak, consumer confidence is declining, and all sorts of nasty things are going on, and they want to raise rates. Okay, that's fine. I think the reality is that raising rates would call into question what I call the unholy matrimony between central banks and governments, whereby the central banks are the back door of the Ministry of Finance, and the Ministry of Finance is the front door. And the Ministry of Finance spends money it doesn't have and has to raise it, and it does it by selling bonds, which the central bank pokes its head out of the back door and promptly buys. Now, all that is contingent upon the cost of capital, the interest rates being kept in negative terms, so that they do not accelerate a massive explosion in debt, which calls into question the sustainability of sovereign debt. So what I think is going to happen is the central banks will, in the main, and most of them are ahead of the US. The US is the kind of Johnny-come-lately to the tightening party. They will go on tightening rates, but they will lag inflation rates. So essentially, the tightening will be there for all to see, but it won't be real for all to feel. And I think that's where we're destined. And it's not a very healthy kind of environment, but I don't really see how they couldn't get out of it. Nor do I think it leads to hyperinflation. It just leads to hyper-mediocrity.
Hyper-mediocrity. David, thank you for that. We'll get back to you for more insights. David Roche there from Independent Strategy. Right, we're going to squeeze in a quick break here, but we will leave you with a look at the price of oil, which is really germane to this topic of inflation, which resumes their march higher. WTI above $84 a barrel. Brent nearly $86 a barrel. We're back in 2 minutes. Let's go back to David Roche from Independent Strategy. David, we went into the break there talking about oil prices, and they are trading well in the high 80s. If you look at Brent, WTI, we're looking at $100 a barrel. given that we are in a situation where we are already seeing price spikes and it's not even winter yet?
I would think we are looking at $100 a barrel, but it will probably only last through the winter and then decline. And of course, once you get up towards $100 a barrel, nice people like the Saudis will pump more, because if they don't, we're going to look at a very dirty situation in financial markets, which they own rather a lot of. So there will be reaction and counter-reaction. I think one point you want to bear in mind is that you and I, prior to this conversation, have never had a conversation in the whole of our long 20 years talking to each other about gas. But gas is even more deadly for the economy than oil. And the Russians are, of course, Mr. Putin, that nice man in Moscow, is doing an excellent job of actually screwing the Europeans on gas, so that the 44% of European gas supplies and about 25% of the oil supplies, which comes from Russia, is now adding a whole new dimension of threat to the European economic recovery, and is part and parcel of that much lauded Angela Merkel's legacy to the German government of having an absolutely dysfunctional energy policy.
And does this spike in energy prices from oil to gas to coal, fossil fuels, tell you, David, that there still is not enough momentum in renewables, and we are still wedded to fossil fuels in many ways?
That is just so true. And it is, in a sense, I don't wish to sound like I'm trying to be comic or ironic or sardonic, but I mean, the next thing we're going to see is we're going to see the COP26 conference, which is going to be absolutely wonderful, but frankly will achieve very little, because most of the good news on renewables is the fact that they are economically competitive. And therefore, if the lobbies from the coal industry, from the power generation industry, are not allowed to totally corrupt the populist politicians, a lot of the heavy lifting on renewables will be done by renewables themselves on a purely economic competitive basis. Having said that, I think the ironic part of it is that we will see a reversal of the policies to lessen the production of greenhouse gas emitting fossil fuels. We will see they will be revived and will be invested in, simply because the renewables cannot fill the gap quickly enough. And for instance, I'm sitting in Hong Kong looking out the window. There's a nice northerly wind, and therefore we can see what's coming in from China. What's coming in from China is a hell of a lot of pollution based upon the fact that they are and having to refire the coal-burning electricity production facilities, which supply 70% of their power, because they have no choice. If they implement renewables and climate-friendly policies like they did by decree from the top, then you get immense economic disruption, and they're having to reverse that. Now, don't expect China to be alone. You're going to have COP26 moving towards nice, healthy greenhouse gas reduction, and you're going to have economic reality digging more black coal out of the ground. And I guess Australia will be clapping its hands.
Yeah, indeed. And as winter rolls around, especially where you are, David, in Hong Kong, it seems likely that the air is just only going to get worse, right? Let me change the subject here. We've been watching missiles flying all over the place the last couple of weeks or so. A new Chinese hypersonic missile. The North Koreans have been firing off missiles again, but a much less obvious and less public sort of threat. Cyber warfare is something that you've been thinking a lot about, especially this whole issue of state actors being able to subcontract the work out to a private outfit and go, hey, I know nothing about this. It's not me.
Well, put it this way. Cyber warfare is terribly cheap. It can be delegated. It can be disguised. And it is much more deadly than people imagine. So the major players are, of course, the ones you would imagine. The Russians, despite the fact that their economy is, depending on how you measure it, either the size of Italy's or 3 times the size of Italy's, has a cyber warfare capability, which is up there with the very best worldwide, and certainly is good, and I think better than the United States. And China is certainly to be reckoned with as a force. and I think up there as well. So this sort of war is really cheap because it doesn't kill a lot of people. It can just simply turn the lights out, which makes life pretty impossible and makes your country very vulnerable.
Yeah, this is very asymmetric. In other words, is what you're saying. It's almost sort of like technological guerrilla warfare, right? And the more worrying thing is, I mean, obviously, most, if not all, companies are aware that this is a risk, but very few of them are actually up to speed in terms of defending against it. I mean, it can't be a question of cost, can it?
No, it's a question of competence. If you look at the boards of most companies, it's got people on it like me. You know, venerable or less venerable oldie-woldies who actually don't understand what the hell most of this stuff is about. So when you get down to the geeks and the people with thick spectacles who are responsible for actually protecting this company, they don't get enough money to actually do it. We saw that in the case of US utilities, where they were operating Windows operating systems which were about 10 years out of date. Well, that's just asking for trouble, because this has to be a state policy driven from the top by people who are competent to do so. And in most cases, the corporate structure of Western companies do not lend themselves to that at all. China is quite a different matter, but Western companies, no way.
David, where you are in Hong Kong, the pro-democracy movement, has it been, to all intents and purposes, crushed now by the national security law and what many see as the virtual annexation of Hong Kong by mainland China?
Well, you'll be relieved to hear that this will be a very short answer for very obvious reasons. And the answer is yes, it has been crushed. And yes, I think that the, shall we call it, convergence of Hong Kong with China is proceeding at a rapid pace, and that pace will accelerate. And there's nothing that I can see on the horizon that would ever reverse that. So that's a reality. And I think also, as we were talking earlier, we were talking about common prosperity in China. Well, everything to do with China, be it national security, common prosperity, whatever the policies are, will be extended to Hong Kong fully. So that whether you're looking at the rule of law or whether you're looking at the ability of tycoons to make excessive profits from the property market, don't draw a line between Hong Kong and China, because there is no line to be drawn.
Understood. David, we'll leave it there. Thank you very much indeed. As always, great conversation, very valuable insights. David Roche there from Independent Strategy. Thank you. Right, we're off for a quick break. As we tail into it, we'll leave you with a look at the winners and the losers in Sydney, which has been trading for nearly an hour. We'll be right back. As stock markets continue to defy gravity, hedge fund manager David Tepper says inflation is the biggest wild card for stock investing. And he told CNBC's Scott Wapner that he's pulled back his equity investments in the short term.
As an investor, I'll use it's like a Warren Buffett line. You know, it's a great asset for the long term. So, but I don't think there's any great asset classes right now. There's, people on your show have talked about the risk of inflation, and the question is, what the Fed's doing. I guess Powell pretty much said he's going to taper today. Online when people expect it. The question is, when will they raise interest rates, and really what is the underlying inflation, and how much is becoming endemic inside the economy? And that's really what we're dealing with right now. So, if you go down different asset classes, stocks, I don't love stocks. I don't love bonds. I don't love junk bonds. I don't like, it's a question, what's the best looking, investment versus other investments when nothing looks that great?
So what do you do? Are you raising your cash as a result of that? Have you taken your exposure to stocks down as a result of that view?
Yeah, we've been probably too conservative this year. We've done okay because of where we were in the market. We were in commodities and oil, but we continue to keep that exposure, relatively low, but still invested. And look, I think, like I said, I think you stay invested in the stock market to a certain extent. I don't think if you don't have your highest concentration that you'd ever have, but you continue some investment. It's expensive to sell and pay taxes, and I don't think we're at that sort of market where you have to worry about that I'm going to get out no matter what, and I want to get I want to go short the market, and, but I don't think it's a great investment right here.
And yet, I don't know, maybe people will continue to do that if they think that rates are going to continue, at least maybe stay where they are, even move lower. All of the risks that are out there, you have to balance that against the fact that there's still a tremendous amount of liquidity in the system, right, David? Even with a taper, you still have the equivalent of QE2 and then some. Does that supersede many of the risks that you see out there?
I don't know. Listen, at some point, it's still value has to play some game. And, look, I think you talk about liquidity, but I guess it's you can talk in banks and money markets. I think Ned Davis did something where the percentage of the market, the percentage of assets, cash and money markets is one of the lowest percentages to the value of the market right now. So it's a question of what is that, what is that liquidity? There's certainly a lot of liquidity. There's liquidity in excess reserves in banks that can go in. So, look, sometimes things don't have to be great investments, and sometimes things don't have to be great shorts, and sometimes you guys like that. There's always some stock that's something for you guys to talk about, so you're not going off the air just quite yet, Scott.
In other news, Italy has called off talks for UniCredit to take over troubled Monte dei Paschi, or MPS. Italy has been looking to privatise MPS after a $6.3 billion bailout back in 2017. The talks collapsed due to differences in valuation and the types of assets to be sold. The Italian Treasury reportedly valued MPS's assets at between 3.6 to 4.8 billion euros, but UniCredit said they were only worth 1.3 billion euros. Rome will now look to extend the deadline with the EU for the sale of MPS. And Paytm has reportedly got the go-ahead from regulators for India's biggest ever IPO. According to Reuters, the Indian fintech company will be valued at $2.2 billion and is likely to list at the end of October. Paytm expanded rapidly after New Delhi banned high-value banknotes, boosting demand for digital payments. It has now diversified its services to include deposits, remittances and insurance. Chinese conglomerate HNA is moving forward with restructuring plans after creditors gave the go-ahead. That's according to a court statement posted on HNA's WeChat page. The group was put into bankruptcy administration in February after liquidity concerns were raised. HNA is expected to receive close to $6 billion in investment after restructuring, which will go towards funding the group's 11 units, including Hainan Airlines. Stay with us as we bring you the opening numbers in Tokyo and Seoul. We'll see you at the top of the next hour. Eight a.m. here in Singapore, 9 a.m. in Tokyo. I'm Sri Jagaraja with Martin Song. Japanese and the South Korean markets are just coming online. Let's bring you today's headlines as well this Monday morning.
Good morning, Sri. Let's do that. Asia is working with a kind of a mixed lead from Wall Street Friday. The Nasdaq fell. The Dow, though, finished up at a new record high yet again. Meantime, U.S. House Leader Nancy Pelosi says she hopes to hold a vote on social spending and infrastructure bills later this week. Back here in Asia, down in Australia, the government there footing the bulk of the bill for Telstra to buy Digicel in a move by Canberra to prevent the company going into or falling into Chinese hands. And more pressure on banks in Hong Kong. The Monetary Authority there saying that lenders need to disclose property of clients who ran afoul of the city's new national security law. Right to markets first, as we always go, top of every hour. We've got Tokyo and Seoul about a minute plus into a fresh week of trade. And here's the picture. Tokyo is down 1% from the get-go. Not a good start. The Korean market, the Kospi in Seoul, is down 0.4%. Losses there a little bit more modest. But Sydney, take a look, is in the money, up 0.1% and a little bit better. Sri?
Martin, Hong Kong markets will open in an hour and a half's time, and news from the territory is that banks there will have to disclose property of clients who breached the national security law this coming as HSBC prepares to release its earnings. Emily Tan has more.
Yep, but we're going to be having all eyes on the banks today with the big British bank due out with earnings. I'll get to that in just a bit. I just want to bring you up to speed in the newest coming through from the Hong Kong Association of Banks as they revised some of their guidelines. This is being written in the FAQ, the frequently asked questions. So these are not official guidelines, if you will, but still guidelines that have been, that all the banks in Hong Kong, these are the local banks as well as international banks, have to pay attention to. They are being advised to disclose property held by clients found in breach of the national security law. Any client arrested or charged for an offense endangering national security or property that is quote-unquote offense-related property after receiving information from law enforcement. The Hong Kong Association of Banks added 5 clauses to the FAQ page in relation to anti-money laundering and counter-financing terrorism. This was after the national security law was promulgated in Hong Kong on June the 30th of last year. So this will apply to Hong Kong and international banks in the city, but as I mentioned before, they're not officially guidelines, but they are advised to follow them. Transactions suspected to be linked to the law should be treated the same as transactions suspected to be money laundering or financing tourism. So keep an eye out on the banks today. We're going to be watching the top on that list there, HSBC, as Europe's biggest bank gets set to report its Q3 numbers. This will happen at the midday break, so just under 4 hours from now, 12 o'clock Hong Kong time, and that'll be followed by an investor conference call at 7:30 BST, or that's 2:30 p.m. Hong Kong time. In terms of what we're expecting today, well, what we've already heard from the bank is that they've been profitable in all regions since the first half of this year, with the continued strength in Asia. Their pre-tax profit at the mid-year was $10.8 billion. In the year-ago period, Q3 of last year, pre-tax profit came in at $3.07 billion. So we are going to be watching whether or not earnings is going to be falling short of that. I'm hearing that there is a favorable decrease in the provisions for credit losses. So it'll be interesting that we're going to be getting a chance to speak to HSBC's Group CFO, Ewan Stevenson, and that'll be a first on CNBC interview just after the earnings come through. And of course, we're going to be getting to flesh out all the major issues. Of course, we're looking at a rate decision, and the prospect of UK rates rising before Christmas could, of course, give the sentiment in the sector a little bit of a lift. We're also going to be looking for exposure to Evergrande. Of course, that story isn't going away anytime soon. What type of loans they have to the Chinese property sector, the spillover in terms of their profit, and the effect on the balance sheet. So we are going to be speaking to HSBC on the back of the company's Q3 earnings. We'll pay attention to that, and we'll be breaking those numbers for you as and when they cross. Martin, it's back to you.
Looking forward to the numbers and also to that conversation. Thank you, Emily Chantan, live up in Hong Kong. Meantime, back to markets. Futures are up and running. Early hours yet, but right now they seem to be indicating what looks to be a soft start when Wall Street gets back up and running tonight, Asia time. But again, several hours to go. A lot can happen between now and then, so we'll continue checking in on how futures develop. Now, meantime, Asia's working with a kind of a mixed lead from Wall Street Friday. The Nasdaq and the S&P were lower. The Dow, though, inched up to yet another all-time high. The 10-year was up past 170 before easing back. Right now, early Asia, the benchmark, U.S. benchmark at 164.65. Meantime, it's going to be a big week for tech earnings, don't forget. The rest of the FANGs reporting. We've got Facebook tonight, Alphabet tomorrow, Amazon, and also Apple on Thursday. Chetan Nayak is Chief Asia Economist at Morgan Stanley. Joins us live up in Hong Kong. Chetan, good to see you and appreciate your time. Hope you're keeping safe where you are. So one of the interesting things that's happened with third quarter earnings out stateside has been the thing that we fear, that is we could see margin compression or guidance indicating that companies are having a hard time passing through higher input costs to the customer. That hasn't come to pass. I mean, most companies seem to have been holding up in terms of margins, if not actually managing to expand them from current record highs. What is the prognosis, do you think, for Asian earnings?
Martin, I'm a macro guy, so I'm an economist. But from my perspective, I think what has happened is that you've got the pricing power, that's for sure. But also, more importantly, there's operating leverage in the system. As you know, we are just coming out from a deep slowdown. And so right now, if you think about the labor market in Asia, we haven't reached those tighter levels. And so what the companies are benefiting is from strong top-line growth, while the wage cost, which tends to be the biggest cost in the system, has still remained relatively muted. We haven't got the tightness in labor market like you have seen in the Western world. So Asian companies are benefiting from that.
Okay, and you know, which leads us to this whole bigger question of inflation, right? I mean, everybody's been saying, look, this is the wrong kind of inflation. It's cost push as opposed to demand pull. Is that really true, though? Because right now there is inflation. A lot of it simply because of this mismatch. Too much demand, not enough supply caused by ongoing kinks in the supply chain. I know that you've been looking at this very closely, though, and you see a silver lining, and I think it means, especially for Asia, it could be or is already starting to kick off a fresh cycle of CapEx.
Yeah, that's right, Martin. And I think what's happening is the demand has definitely been stronger. So yes, we have the supply constraints, but if you sort of try and break that demand and supply problem, the first thing we want to look at is how is the global GDP doing relative to pre-COVID path? And we are already reaching pre-COVID path, which tells you that demand is relatively strong. And in the meantime, because of pandemic, initially there was a slowdown in investment. So we have supply constraints. And also the other important point that we keep in mind is that the Asian story is very much dependent on goods trade. And because of pandemic, if you look at the goods component of global GDP, that's actually gone even higher than pre-COVID path already. So there's been sort of a demand shock for Asia in that sense. And that's kind of been a key reason why we are seeing this demand supply shortages. And then, of course, there are supply shortages in the context of chips, as we know. Then we have logistics challenges, and we have decarbonization-related impact on energy. But in our view, all the three sources of supply constraints are also beginning to ease. And more importantly, as you mentioned, from a longer-term perspective, what is important is you need that CapEx to come through, and that is coming through, and it's getting a bigger kicker because of these supply shortages. So this CapEx cycle is unlocking a more sustainable recovery in Asia.
Chetan, good morning. Can you give us a line on the China real estate tax plan? Does this give you more conviction in the longer term in the sustainability and the stability of the sovereign and the credit profile and fiscal balances?
That's right, Martin. Sri. You know, what we are looking at is really the whole effort from China to fix the longer-term sustainability issues. And that is one of the important areas they have been working on for a while. We saw earlier the industrial companies' debt issues being resolved. Then we saw the financial sector, and now it's a turn of property sector, which is going through this adjustment. And it's really going to help bring sustainability to China's growth rate. Nevertheless, you are going to see a structural decline in China's growth rates. So we just recently put out a report where we sort of downgraded China's medium-term growth, i.e. 2022 to 2025 period growth from 5 to 4.6%. So there is going to be a compromise in slower growth, but it will lend more sustainability to China's growth outlook.
Chetan, the central banks world over in this region as well seem to be really struggling with a dilemma, and that is the wild card of inflation. They can't ignore it anymore, can they? And if they don't ignore it, if they do intervene and tighten, the quandary is they could kneecap this very tentative recovery. What's the most prudent course of action then?
Well, I think the real reason why they are in this kind of quandary is because you have supply side shortages that are causing inflation, and as far as the labor market is concerned, it is still not fully in the place where they can feel comfortable to take up policy rate tightening more aggressively. But, you know, ultimately they will have to still look at the labor market and manage this supply side inflation by coming out and saying that, look, if there is a problem on inflation, we will be ready to act. And so in that sense, you try to manage inflation expectations by hawkish rhetoric, but still keep an eye on the labor market, because ultimately they don't want to compromise on their main objective of maximizing employment. And that's something that has been a bigger issue in this cycle because job losses have been more concentrated in the low-income segment. And that is a political issue as well for them to watch out. So my suggestion would be to focus on the labor market and try and manage the supply side shortages with hawkish rhetoric.
Understood, Chetan. Thank you very much indeed for those insights. Chetan Iyer there of Morgan Stanley. Coming up next, we'll talk to John Sharp, Deputy Chairman of Regional Express, about how the Australian airline is capitalising on the gradual reopening of the country's borders. That exclusive interview coming up next.
Welcome back Monday morning here on Squawk Asia. Tourism-related companies poised to take off as Australia starts reopening its economy. Will Kalors with more down Sydney side. Good morning.
Good morning, Marty. Yes, this is a very buoyant time here in Australia, considering the fact that over the course of the last 2 weeks, we've had the lockdowns ending here in New South Wales and also down there in Victoria. We've already got some activity between New South Wales and Victoria, and that actually comprises one of the most profitable routes in the world for airlines. So you're talking the Sydney to Melbourne route, and at the same time, we've got the news that coming up later on this week that Victoria, once it hits those 80% double vaccination targets, is going to have further restrictions eased. But it is an incredibly important holiday period here in Australia when you think about it from the context of the businesses here in Australia, those tourism operators, the people that do have those businesses in those small towns that are heavily dependent on domestic tourism have been struggling for the last 18 months. But all of that is set to end, barring some differentials when you do think about some states like Western Australia who remain closed. But the hope is that by Christmas, we are going to be entirely open. So this all benefits, obviously, the airlines, and one of those airlines that has become, from, I suppose, relatively smaller origins, one of the major players in terms of the big three here in Australia of the domestic routes, and that is Rex Airlines. And they've announced a suite of things that they are looking at in terms of really taking it to the other incumbents, Qantas and Virgin Australia. And I'm very pleased to be able to welcome the Deputy Chair of Rex Airlines, John Sharp, and he's joining us live now via Zoom. John, thanks so much for being here. We were just discussing this in the break a little bit earlier before. You look at what you're doing over the course of this period, and it does look like in terms of pricing, in terms of what you're offering, you're really taking it to Qantas and Virgin in terms of, I suppose, offering cheap flights during the holidays where you don't normally get that for an Australian consumer.
That's right, Will. I mean, what they're offering is discounted flights, but they're blocking out a period from the middle of December to the middle of January, which is a period when everybody wants to travel. They're blocking it out for access to those cheaper flights. And what Rex is doing is saying, we're going to offer a $69 fare between Sydney and Melbourne, Sydney to Canberra, Melbourne to Canberra. That's $69, full service. You'll get luggage and refreshments included, and $99 for the regional network in New South Wales. And that, again, will be available during the period when the other airlines are blacking out those sales, access to those sale prices. So our sale prices will be available right through that blackout period, right through to the end of April of next year.
Okay, so this is good news, I suppose, for the punters, good news, I suppose, in terms of the economy. But in terms of your shareholders, is this going to be something that you're going to be making money off?
Well, we certainly intend to make money. That's the whole purpose of our business. And Rex, unlike the other airlines in Australia, we've been, up until COVID anyway, always profitable. We've had no debt. So, you know, we're unique in that sense. So the purpose behind this is to get people back to flying. We want to celebrate the fact that the country's opening up, that people can travel more freely, and our staff can be re-engaged and working as they normally would. It's a time to celebrate, and the best way to celebrate is to bring these super sales in. So we've got, you know, $99 fares in the regional network, $69 on the capital city network. We're giving a guaranteed refund if you can't take a flight due to a COVID restriction, like a border closure or some travel restriction. And all of our staff, by the way, our frontline staff, are all double vaccinated. And so people can book with comfort, but it's knowing that they'll be so safe as possible, travelling with Rex, and they can get a refund if something goes wrong due to COVID. And it gives people an opportunity to get out there and travel, and it'll really boost the regional economies in particular, because for $99, travelling into regional Australia is very, very cheap, and people have been locked up for the last few months, and they'll be itching to get out and travel.
Yeah, I can imagine, John. And good morning. This is Martin. Let me quickly jump in. So, cheap and cheerful. I mean, for an airline like yours, which is smaller and also in the discount space, talk to us about costs. I mean, right now, maybe not a problem. As you expand and things reopen, it could be a problem. That is, of course, your number one cost: fuel, up to, in your space for smaller budget airlines, a third of your total bill. How are you handling that? What's your strategy like? Are you hedging?
Yeah, we do, Mark. We do hedge our fuel prices, and that, generally speaking, gives us a distinct advantage in the marketplace. And of course, you pointed out, fuel prices have gone up, oil prices have gone up, and with it, fuel at the same time. But we've got good locked-in prices, so that hasn't had an immediate impact on us. But at the end of the day, you know, we want to be out there as competitively as anybody else. And that's why we're doing what we're doing, offering these fantastically low prices with no blockout period or blackout period, so people can travel when they want. And we're a full service airline. So, you know, it's really good value. So if you're in Australia and you want to travel now with these restrictions being lifted, it's a great time to be traveling.
John, if Rex is repositioning for the return of growth in the domestic market, are you hiring more staff and are you expanding the fleet?
Well, we've hired a lot more staff over the last 18 months to accommodate our expansion into the capital city network, the domestic network, and we've taken on board 6 737 aircraft to facilitate that. And our plans were always to expand with an initial 2 more 737s in the next few months, and ultimately to go to 10. The plan was originally to get to 10 by the end of this year, but obviously the recent lockdowns have delayed that. But our plan will be to add additional aircraft as demand requires it and as we expand our network. So, you know, we are, as you point out, a smaller airline compared to particularly to Qantas, which is the sort of the legacy airline in Australia. It's been around 100 years. Rex, in its different forms, has been around for 70 years, but as a regional operator. But our expansion will mean more jobs for people in Australia in the aviation industry, and we see us employing more people next year, and we see us adding more aircraft to our fleet next year as demand picks up and the economy returns to something like you describe as normal.
You know, John, 737s, single aisle. I mean, they're the workhorse. They're sort of like the DC-3s of the modern jet age, right? And I'm not sure about the age of your inventory, but as a model, you know, the variations aside, a little long in the tooth, which raises questions about fuel efficiency And my next question, whether or not in terms of emissions, you are exploring alternative or hybrid fuels for your aircraft.
Well, we're certainly exploring all sorts of ways to reduce our emissions, and some of the things that we've introduced inside the aircraft, for example, we've just been recognised with some awards recently for the innovative packaging of food, for example, or delivery of food onto the aircraft, which is quite unique, and that's helped boost our our environmental credentials. But yes, we're keen to find ways to reduce fuel burn, because that's obviously to our advantage. It's also to the environment's advantage. And in this initial phase, when we are developing our domestic network and moving into jet aircraft, as in the past we've been operating turboprop aircraft, the Saab 340s. As we move into the jet, we'll be looking for more and more efficient aircraft as time goes by, and we'll give any trial that makes sense a go, because at the end of the day, it's in our interest to reduce our fuel cost and to reduce the emissions that we produce as a result of operating. So yeah, we're in it for whatever we can find to reduce those costs and those emissions.
John, two quick questions from me. When you do the channel checks, can you give us a sense of the pent-up demand that is in there? Australians who want to travel domestically again. What does that look like heading into 2022? And back to the pricing, $69 on the city network, $99 on the regional network. What guarantee can you offer your passengers that that really is locked and loaded in an environment of rising operating costs that I'm sure you're having to cope with?
Well, this sale is available now as we speak, started today. And, it's for travel between now and the end of April of this year, with no blackout period, so that people can travel through that busy time around Christmas, middle of December through to middle of January. So it's locked and loaded, guaranteed that we will be able to offer those services at those prices, and we're doing our best to promote it. And in terms of the response that we think we'll get out of this, is going to be a tremendous response. We've noticed in the last few days we've had significant increases in bookings as we're getting closer to the opening up of the state borders between New South Wales and Victoria, for example. And so the numbers of bookings have gone up quite dramatically. But as of today, with these new very competitive low prices, I think we're going to see a record day for bookings in our business. Our expectation is this will create a record, because people are really chomping at the bit to get out.
John.
And they've been locked up at home for so long, and this is the opportunity. And with prices like this, there's no better time to travel.
John, we're just out of time. We wish you all the best, and we do hope that demand does pick up again and Aussies can travel. John Sharp there off Regional Express. Thank you, sir. We're going to squeeze in a quick break here. We're back in 2 minutes. Welcome back. As we approach the United Nations Climate Change Conference, which kicks off this Sunday, China has issued measures to achieve its carbon emissions goals as well as more specific targets. The Central Committee and State Council want renewable energy to make up 20% of total energy consumption by the end of 2025. That will rise to 25% by 2030 and 80% by 2060. In order to achieve that, China will ban new oil refining and energy-intensive projects. Controls will also be applied to coal power industries. Beijing hopes to bring CO2 emissions per unit of GDP down by more than 65% by the year 2030. Martin.
Right, meantime, Shri, Saudi Arabia, the world's #1 oil exporter, is going to invest more than $180 billion to try and reach net zero carbon emissions by 2060. Crown Prince Mohammed bin Salman, MBS, explaining how the kingdom would hit that target in a pre-recorded message Saturday. Take a look.
This initiative means to change the mix of power in the Kingdom of Saudi Arabia, to reduce the consumption of power, to increase the efficiency of production, and to invest in new energy sources like hydrogen. Also, we announced the union of the Kingdom to the International Pledge of Methane, which targets to reduce the international emission of methane by 30%.
Bahrain, meantime, also announcing a goal to hit net zero carbon emissions by 2060, Shri.
Martin, let's take a look at WeWork shares, which continue to see strong buying in their second day of trade following a listing via SPAC merger. That's after missteps and uncertainty over founder Adam Neumann forced the company to pull its stock market debut back in 2019. Investors seem to like the revamp. That saw Neumann taking a back seat and parent SoftBank installing Sandeep Mathrani as CEO. WeWork Executive Chairman Marcelo Claure, meanwhile, telling CNBC he doesn't see Neumann as a hindrance going forward.
Adam deserved credit. Adam was the visionary. Adam came up with the idea. SoftBank invested in the idea. And then the next chapter came to bring somebody like Sandeep who can basically execute an amazing turnaround plan. So everybody had an important role to play here. Adam Neumann going forward, he's a shareholder. I believe he has rights to be a board observer, and we welcome anybody who comes up with ideas.
Let's bring in Elliot Brown now, co-author of The Cult of We, which chronicles the missteps under WeWork's founders. He joins us on the line from San Francisco. Elliot, thank you for your time. First of all, what do you make of these self-dealing charges against Adam Neumann? Is he being held fully accountable for them? And how likely is it that he will face fines or even jail time for breaking his fiduciary duty?
On the concept of sort of fines or jail time, I unless something changes, that ship seems to have sailed. I know a number of regulators looked into it after the 2019 sort of failed IPO. I think essentially what's happened is Adam Neumann ended up getting very rich off of WeWork and legally, as far as I can tell and anyone else can, was able to, sort of renegotiate things and steer, and that was all disclosed. So it's kind of an example of a system that actually allows this to happen as long as there's disclosure.
Right, but in the course of your investigation, do you believe, or was there any evidence suggesting that Adam Neumann did anything egregiously wrong or illegal, or was he just basically a narcissist who just utterly mismanaged this company?
Yeah, I mean, I would say more toward the latter. Right. I mean, Matt Levine found this at news like this. Everything is that's not a legal opinion, but people have looked at this, and I think that the thing with WeWork was just that Adam was a really bad manager. He really was in it for himself. He leased buildings to himself. He was constantly pushing to get sort of more money off the table for himself. But that is legal by our system as long as you sort of disclose it. So I think it's more just that he has ended up as a very wealthy man after mismanaging a company and getting pushed out.
Yeah, and Elliot, it was that disclosure, right? The S1, when that came out, when the Journal got a hold of it, that sort of blew the lid off this thing. I mean, the title of your book, The Cult of We, a lot of reviewers are saying, look, after reading it, you should have titled it The Cult of Me, as in Adam Newman, right? Here I'm drawing parallels with Alfred E. Newman. I mean, it's comical just how rich he got off this thing. But anyway, look, be that as it may, they finally managed to pay the guy off, finally managed to IPO, and now if we can take a look at the valuation chart, it's been just an absolute roller coaster, right? At peak, $47 billion, right? Went down to almost nothing, and now we're up to about $9 billion. So the question is, with Newman out, under new management out, and as the world and the U.S. emerges from the coronavirus, does this business model work? Can it still work?
Yes, that's a really interesting question. And as you point out, I mean, it's a $9 billion company that took, well over $11 billion of investment to get there, which isn't generally the way we want these things to work. So right now they're at this position where they're emerging, we're emerging into something post-ish COVID, the endemic phase of COVID. And I think the big question, which definitely we don't have an answer to yet, is whether it's actually a good position to be for a company that offers temporary office space. Because if you're a corporation, there's like a pretty good reason you might actually want a 3-month or year-long lease instead of signing a 10-year lease. And that's kind of the center of their business. So I would say there's some good reason to think that it'll be a working business, but we really don't know yet.
Yeah, and pulling it broader and looking at things in perspective, I mean, is there from your work on this book, is there sort of a broader sort of business or almost moral lesson to be drawn from this? Because, I mean, one of the biggest backers, right, SoftBank, Masa Son, literally he committed billions of dollars on a handshake in the back of an SUV, but he just got it wrong. I mean, he just read Newman all wrong, did he not?
Yeah, I think one of the things that we learned from the reporting out the book was we're both from Wall Street Journal. Me and my co-author Maureen are both financial reporters, and the financial system overall was much more reckless than we thought it was. I mean, you had people, particularly Masayoshi Son, committing billions of dollars with, basically based on minutes of decisions. Of contemplation, and then going through a long period of due diligence, but really the purpose of that is to back up the initial decision. So, if there's a lot of lessons from WeWork. I think one is that if you give a 30-something billions of dollars and have zero control, the 30-something gets full control over the company, and you have no ability to say anything about it. Then bad things can happen. And that's sort of exactly what happened here.
Yeah, Elliot, Adam Newman sort of walks away with an 11% stake in the company. What guarantee or what checks and balances are there in the system that will prevent him from abusing that position as a stakeholder?
Yeah, at this point, I think he no longer, it took a really long time, but he no longer has sort of enough shares and enough potency to his shares to do anything. But that changed really relatively recently. So one of the sort of byproducts of having so much control was that after the company was nearing insolvency in 2019 and then again early this year, he refused to sort of leave the scene and give up his voting shares that gave him control without getting paid extra. And so if you mentioned he has 11% of the company. He actually got an extra sort of, multiple percentage points of the company simply by refusing to leave and threatening to sort of throw a wrench in the mix when he was negotiating with SoftBank. So they gave him an extra award that was worth basically $250 million that he gets right now for being a person who used to run the company. And so that's generally not what we like to see with sort of CEOs who have maximizing shareholder value at heart.
Yeah, although I understand, I mean, that 11% stake, I think there's at least a 6-month hold or a lockup on those shares. He can't let go. And I guess the good news is he's not on the board anymore. All right, Elliot, listen, we got to go. Great to talk to you. Appreciate the time. Good luck with the book. Elliot Brown, the co-author of The Cult of We, joining us live. We're going to take a quick break. Squawk is back in 2.